there are challenges as well as benefits associated with CBDCs. And let's take a moment or two first to talk about some of the challenges associated with them. Number one, CBDCs can impact deposits. The central bank could choose to pay, or for that matter, charge interest related to CBDCs. Now, here in the U.S., this would be a fundamental change to our current form of currency. A unique feature of cash is that it's not interest-bearing. Sad to say for the dollar bill that's in my pocket right now. Now, if the Fed provided an interest-bearing CBDC, the Federal Reserve's chosen rate would largely determine the interest rates that banks would charge on customer deposits. How is this so? Well, it's because bank deposits in CBDC would be such close competitors. A bank that offered a rate much below the CBDC would probably experience a loss of deposits. Conversely, a bank would probably attract deposits by offering an interest rate slightly above the central bank issued CBDC. An unavoidable consequence of any CBDC would be to move money out of bank deposits and into cash, and in this case, digital cash. Those deposits would no longer fund bank loans, which are the primary asset of any financial institution, as well as treasuries and other assets. The bank's lending would decrease in supply and increase in cost, as banks would need to pay a higher rate in order to persuade businesses and consumers to hold deposits rather than CBDC. Now, another issue to consider is anti-money laundering. An anonymized token-based CBDC would make the monitoring of financial transactions as a tool for identifying illicit activity for law enforcement virtually impossible, and to the extent that it was used cross-border, in the use of economic sanctions as a foreign policy tool. This one reason alone is why many experts often say that CBDCs are not really a viable way to issue currency. Another issue to look at would be around privacy. There's always a question about how much customer data in a CBDC model the central bank would see. Think about it. A governmental repository of all personal transaction data would definitely raise privacy questions and concerns. Another issue to look at would be around concentration risk. Currently, the U.S. payment system presents a variety of ways of making payments, and it really avoids any single point of failure. You could pay with a check, you could pay with cash, you can pay with credit card, you could pay with debit card. However, depending on how dominant it became as a method of payment, a CBDC could come with additional risk associated with concentrating payment to a single payment channel. And then there are national security challenges. Any CBDC would be an attractive target for both state and non-state actors wanting to harm or to extort the U.S. National security would really depend on the viability of the technology that would underlie the CBDC system, so that the ability of a rival nation state or terrorist group to create or destroy money, or just to create uncertainty about which digital dollars are real and which are fake, would threaten the U.S. economy. Now, of course, this is possible that a sophisticated state or non-state actor could attack our existing payment rails, but we do, in the current model, have a great deal of diversification, as I referenced earlier. If, in fact, CBDC were issued by the central bank and became exceedingly popular, the threat of concentration risk would definitely grow, as would the threat from a national security perspective. Another concern is the balance of power. Governmental power would be increased under a model where the central bank is issuing digital currencies. And under every version of a CBDC design, the Federal Reserve is, in fact, issuing those currencies. In one way or another, the commercial banking system would have to rely on the Federal Reserve for its lifeblood, which are low-cost deposits. The Fed would be able to increase or decrease the availability of deposits at its sole discretion. In essence, the business of banking would be absorbed by the bank. This power over commercial banking would parallel and reinforce what the Fed already has over capital markets, in which some are urging it to expand even further. So it would, in fact, be another challenge to consider. And then there's the cost. There are currently no estimates of what it would cost to develop or implement a CBDC. Ongoing costs would have to be offset to some extent by reducing the cost for maintaining paper currency, and that may in fact be an organic result of issuing CBDC. However, the net cost would have to be borne by the taxpayer in the form of lower remittances to the Treasury from the Federal Reserve. Now, that being said, there are a number of challenges that have to be addressed. However, there are also upsides to a CBDC. Number one, providing access to central bank money. In jurisdictions where access to cash is less prevalent, there's a danger that households and businesses won't have access to risk-free central bank money. And so some central banks think that it's an obligation to provide public access, and that this access could be critical for keeping confidence in a currency. A CBDC could act like a digital banknote and could further fulfill this obligation. Now, this upside is probably not as relevant here in the U.S., where we have much broader access to cash. However, it is something to consider as a potential benefit for a CBDC, though. In terms of wholesale markets, the main argument that's made when it comes to CBDCs is that the presence of a CBDC could, in fact, create more efficiency when it comes to settlement for wholesale transactions in terms of operational costs and the use of collateral and liquidity. And they could be more secure by using a wholesale CBDC. Central banks in many different geos have been conducting experiments involving CBDC and DLT, or distributed ledger technology. The results of these early experiments, however, have not shown much benefit for wholesale payments, and that's because the design of the infrastructure using DLT today would look like what is already in place to support wholesale payments. Probably as a result of the results of the experiments that have taken place is one of the reasons that as central banks begin to seriously look at implementing CBDC, they tend to focus on retail rather than wholesale application. CBDCs could also provide an improvement to our current electronic benefits payments process. You know, part of the COVID response was the utilization of EIPs, or economic impact payments, that were authorized by Congress to help get cash to those that were impacted in the U.S. That process was pretty challenging, as many of those payments were made electronically utilizing the ACH, which required verification of customer accounts, and that could, along with the distribution of the funds, take anywhere from days or weeks. And for payments that couldn't be made via ACH, paper checks were issued, which were also cumbersome to the process and took even longer. Both processes also came with a significant amount of fraud. Thus, some have stated that a CBDC would have been a benefit and would have supported instantaneous payments in the case of those economic impact payments. And then there's the issue of resilience. Cash serves as a nice backup method to electronic systems. Those networks cease to function or are disrupted. However, if access to cash is marginalized, which it could be in the case of a CBDC, it would be less useful as a backup method if the need arises. A CBDC system could act as an additional payment method, though, providing additional operational resilience. You know, if the U.S. adopts a digital currency, it could work as a viable alternative to cash, but it would also have to have the built-in advantage of quick money transfer since it's also electronic. Even though a digital currency would be electronic, it still, though, would have the ability to be utilized in an online as well as an offline mode. There would need to be a way to allow the exchange of CBDCs in cases where participants to a transaction, either one or both, may not have access to Wi-Fi or be on a cell network. So what does all of this mean when it comes to Regions in our payments business and our payment strategy? Well, Regions continues to monitor developments closely within the digital and cryptocurrency space, and that does include CBDCs. The Federal Reserve has expressed caution in this area, though. They've noted that the stakes are high and that any decision that the Fed would make would need to align to and be in coordination with congressional action. You know, the path forward is currently pretty uncertain, and there are many choices even after a decision that is made whether or not to move forward with a CBDC here in the U.S. as to that would need to be ironed out. And that could drive a variety of different outcomes. But rest assured, Regions is committed to positioning its payments business in a way that will provide its customers with the solid value, ease of experience that they've come to rely upon and to expect.